Okay, we might have a few more folks joining in, but I'll go through my slides. That's the unimportant part, and then we'll get to Devin Eckbert, our guest speaker today. First off, folks, I want to express my appreciation for you joining us today. Someone who scheduled this meeting today, this webinar, and it would be this person right here, didn't quite realize that this was election day. So obviously a very busy day, and really appreciate you taking time out of a very busy day to spend with us to learn about some charitable giving strategies, yeah, that I think can certainly be beneficial for those who are, inclined for some philanthropy, as part of their overall giving strategy. But before we get started, I wanted to just go through a few intro slides. And many of you, I think, who have joined our webinars before, you know that I always do this just to give you a little bit of a precursor as to who Cornerstone is, because there's a very, very good chance that you may not know who we are, and there's a very good reason for that. Your financial advisor who invited you to this is an independent business owner. They structure their business in a very independent way, and that in some cases they may brand as something other than Cornerstone. And so again, you get these emails from Cornerstone and have no idea who that is. So just a little background. We're a registered investment advisor based in St. Louis, Missouri. You'll see on the screen, we have advisors scattered out through 15 different states, totaling close to 130. We have just under $9 billion in total client assets that we manage. And there's over 54,000 clients that we work with as part of that. Now, I did mention that your advisor might brand as something other than Cornerstone, and you see a number of the brands on the screen. We actually have advisors who use 38 different brands under the Cornerstone umbrella, and that's something that we completely support. When they decide to be an independent business owner, we don't want to come in and say you have to use the Cornerstone brand. If they'd like to brand as something other than that for their vision, we certainly want to support that. All of our advisors do work with LPL Financial as their broker dealer. And many of you, I'm sure, have probably seen the envelopes coming in the mail for your statements, or you might use the online access to view your accounts, and certainly you'll see LPL. But if you're not familiar, LPL is the largest independent broker dealer in the country, with over $1.4 trillion in total assets under management. Over 24,000 advisors call LPL their broker dealer, their preferred broker dealer to work with their clients. And I think maybe one of the most important things that you see on the screen there is in the bottom right. LPL has 0 proprietary products. And so they don't come in with a prescriptive or maybe an in-house view and try to guide clients into an in-house product. They really value independence, both in terms of the business model, but also in terms of the thought that advisors are bringing to their clients' personal financial situation and really trying to meet those goals. If you bring all that together, your financial advisor, along with Cornerstone, with the backing of LPL, what we're really trying to bring to you is more support, structure, and scale, which just allows your advisor to have more time spent with you. This webinar today is a good example of that. We've done the planning, we've gone through compliance and gotten that approved, and all your advisor really had to do was send out that invitation to you and not take time out of their day or their team's day to really do that. So again, just one of the small examples of that. Just a quick housekeeping note. If you do have questions for our speaker today, the way that you'll submit those questions is actually through email. And this is, I mentioned compliance before. This is one of those things that we have to do to check that compliance box for the webinar. You cannot use the chat function in Zoom. So if you do have questions, please email those to cornerstonewm@lpl.com. Once again, that's cornerstonewm@lpl.com. Those will come to me, and I will ask Devin on your behalf. So I'll remind you once again as we get closer to the end of the webinar, but again, Cornerstone WM, no dots, no spaces, just all one segment at lpl.com. Well, it's my pleasure to introduce Devin Eckberg. Devin Eckberg has been a senior consultant with PIMCO for over 15 years. I will tell you that I have over 25 years in the business, and every time I hear Devin speak, I learn something. He's always bringing great content, both educational as well as just informative, forward-looking for advisors and their clients. This topic that we have today is certainly no exception. And it's one of those things that, obviously I think is near and dear to a lot of folks' hearts in terms of their giving strategies and where they like to make impact with their overall financial portfolio. But the key is there are smarter ways to do that than others. And Devin is going to share a few of those strategies today to really help you with making that impact in the most beneficial way for both the charities you support as well as the long-term benefit of your portfolio. So Devin, I'm going to turn things over to you. If you have any slides to share, please feel free to do so. But thank you for joining us today.
Hey, thanks so much, Bill. I really appreciate the kind introduction, and likewise back at you. Everyone that I've worked with, Bill, from your team and just Cornerstone Wealth Management in general, all the advisors that are affiliated with your firm, just top of the tier. I get to work with advisors from all over the country, and there are no, advisors that are more dedicated and knowledgeable than the group that you work with. So it's an honor to be here as well. Thanks for joining us here. I can't think of a better thing to do on election day than think about ways of giving back. People always ask me, like, who are you voting for? I'm like, and my answer is a little bit cynical. I love both candidates so much. It's hard to choose between the two, no matter where you fall on the political spectrum. So I'm gonna go ahead and share my screen here. And let's just talk a little bit about the who, what, where, and why of intentional giving. And maybe more importantly, a lot of people don't connect, their acts of charitable giving or philanthropy with their overall financial plan, with their wealth management plan. But I think there's a lot of ways that we can think differently about it. So I'm going to share some of the things that we've learned of what works and maybe what doesn't work. Start out with a couple of quotes that I really love here. So Warren Buffett says, look, if you're in the luckiest 1% of humanity, which I guarantee you are, when we look at the global aspect of things in history, you owe it to the rest of humanity to think about the other 99%. And Minor Myers Jr. says, go into the world and do well, but more importantly, go into the world and do good. And again, I can't think of a better day than for us to think about some of this stuff. Now, what I'm seeing is that Americans in general are very, very generous people. In 2022, we gave something like $500 billion to charity. I think in this year and last year, it's, something similar to that. I think COVID, the pandemic, woke up a lot of people to the needs of their communities around them. And so we just see more and more, as people are becoming aware of some of the needs around it. And it really is an interest in giving back. We see a lot of reasons why people donate to charity. And some of the more common reasons that you'll hear folks like us talk about it in the financial industry is, some of the tax incentives and deductibles and things like that. But that's not really the reason people are giving. First of all, the recipients of this charity are they change from year to year, but overall it's religion, it's human services, which is things like supporting communities and neighbors and homeless populations and things like that, education, health, arts, culture, humanity. These are things that people care deeply about. And you're probably in the same boat. And, it's about creating a legacy and maybe in a more intentional way, in a more targeted way to some of the things that you care about the most. And when we survey people, what are your motivations for giving? Like I said, the tax deductions almost don't even show up on the list. It's at the bottom of the list. It's personal values and beliefs. It's interest in that issue area, maybe because they've been impacted by it or a family member's been impacted by that issue. Maybe it's a recognizable or reputable nonprofit that they care a lot about. They have perceived needs of those issues areas that they want to be a part of. So all of these different reasons are the motivations, and you probably fall somewhere in here as well. Again, by virtue of you attending this session, you can tell that you care deeply about this. So let's talk about what most people think about in terms of giving, which is sort of the more simple ways of giving. I'll get into much more complex ways of giving here in a moment, but let's take a step back and think about the simple assets that you might think about. Cash. And indeed, that's actually how most people give to charities, is through cash. They go to a fundraiser, they go to their church, they pay their tithing every year religiously, they write a check, they go to a fundraiser, they raise the paddle, they write a check, and it's very easy. Sometimes that documentation happens where you receive back documentation, sometimes you don't, but that's very, very common. Some people write off like vehicle expenses. That's a pretty simple way to do it. There's a standard rate for miles driven in the context of providing charitable services. You can actually deduct that off of your taxes. A lot of people give household items to places like Goodwill and the Salvation Army and other places. So like older furniture and clothing and appliances that kind of get reused. There's even software programs that you can use to help value some of those services and use those for deduction purposes. And a lot of people give vehicles like cars and boats and airplanes, where the charity actually liquidates those vehicles and then uses those dollars for charitable activities. So in a simple way, there's nothing wrong with these areas. And there are some tax deductible, benefits to doing it this way. But when people start thinking of larger dollar amounts and to fulfill maybe larger objectives that they have in line with the larger financial plan that they have, you start thinking about more complex assets. You've probably heard that giving things like appreciated investments, so appreciated stock and other types of investments, mutual funds, ETFs, things like that, is a pretty tax efficient way to give. And I'll go into the specifics of what I mean by that. But it's tax efficient in the sense that the deduction is based on the value that you give, but you don't actually have to sell the security and pay the taxes on it before you give it. And that's usually suitable for larger and maybe like one-time gifts. People give collectibles like artwork and jewelry and antiques and stamps. Again, there's some handcuffs to that, but that's a pretty common thing. Some people donate directly their retirement assets, so funds in your IRA or your 401k. It's called a qualified charitable distribution. There's some benefits to that as well. I put this one in here because I hear it a lot, but these conservation easements, these are people who donate maybe pieces of their property for public benefit, like water rights and other things like that. That's definitely been abused, and the IRS looks at those pretty carefully, but that's still, an area of complex assets that people give. And whenever we talk about this, it inevitably kind of comes up. And again, if you have questions, go ahead and shoot those questions to that email that Bill provided earlier. But there are some things that are just not considered gifts, and we may give them freely, but they're just not considered to be gifts from a tax perspective. Like the value of your time or services is not considered to be tax deductible. The cost of a raffle or a bingo or a lottery ticket where you're receiving something back in return, potentially for those dollars, that's typically not a gift. Gifts that benefit the donor, it either reduces or eliminates the contribution of the value of the gift that you're giving. So there are some things that, we may give freely, but don't necessarily qualify as gifts. Now, when you're trying to consider what to give as a gift, we do have to kind of start thinking strategically, and especially when we connect it to the realities of your tax situation and your financial planning. So here are some categories that the IRS has acknowledged to be categories, and whether you give these assets to a public charity or a private foundation, you're allowed to take a tax deduction based on either its value, like its fair market value, FMV, fair market value, or your cost basis in that particular item. And you can see here the different categories. It matters for valuation purposes what the property is and what the deduction is that you're allowed to take. And then it also matters what your adjusted gross income is and the percentage of that gift as it relates to your adjusted gross income. We'll get some examples here in a moment, but these are from the IRS's perspective, things to consider when you are giving different types of property. So cash, for instance, you can, it's worth what it is. There is no other valuation of cash than what the value of that cash is. And you can deduct up to 60% of your AGI. So if you make, say, $100,000 a year and you give a $60,000 donation to your church, you can actually deduct that entire $60,000, but not more than that. If you give stock, for instance, appreciated long-term capital gain property, a stock that you've owned forever, it's appreciated, you don't want to pay the capital gains tax on it, you can deduct it up to its fair market value. Suppose it's $100,000 of stock, but you can only deduct up to 30% of your AGI. So if you make $100,000 a year and you give $100,000 to your church or to another charitable organization in the form of stock, you can only deduct up to 30,000 of that this year. And then you can actually carry that forward into future years. You'll fully deduct it, but you'll do it over a series of years because of that AGI limit. I hope that sort of makes sense. So all of those factors and variables kind of come into play when you're giving appreciated security. And I like to spell this out with an actual math example. I know you didn't come here to do math, but it kind of hits home the value of giving that appreciated property, like what actually happens when you give appreciated stock and how it benefits you and benefits the charity. So on the left-hand side, here's a typical example. Somebody has $100,000 worth of stock. Their cost basis in that stock that they purchased a long time ago, let's say, is only $20,000. So there's $80,000 of an unrealized capital gain. Now, if you go ahead and sell that stock today and you receive $100,000, you've now recognized taxable income by selling that stock. If you're in the highest marginal tax bracket for capital gains, you're paying 23.8% on that $100,000, or excuse me, on that $80,000 gain. So you're paying $19,000 in capital gains rates. Now your charitable contribution is now only around $80,000 instead of the full $100,000 that you sold. And then you take a tax deduction. If you're in the highest marginal tax bracket for income taxes, that's 37%. So you get about a $30,000 tax deduction. So that's the typical way people might do that, but they miss out on the ability to do what's on the right-hand side of your chart. So same appreciated stock, $100,000. Your cost basis is $20,000. You've got this $80,000 gain. Well, instead of selling it and recognizing that gain on your tax return, you're just going to go ahead and donate that $100,000 directly to the charity. Let the charity sell that stock because they're a 501c3 organization. They're not a taxable organization. They're not going to pay any taxes on that at all. So the charity actually receives the full $100,000. And you can take a charitable deduction on the full $100,000, not just the proceeds after taxes. So your gain or your taxable deduction is $37,000 instead of $30,000. I hope that makes sense. So in the end, the charity gets more. In the end, you get a larger deduction and everybody sort of becomes happy. There's another scenario here, and I mentioned it earlier, where you can actually give a charitable distribution directly from a retirement account, like an IRA or a 401k. Now, there's other retirement accounts that don't qualify for this. So if you have like an employee, like a SEP account or a simple IRA, it's not eligible to do this. But for most people that have an IRA or a 401k, this might be interesting for them. If you're over age 70 and a half, you're eligible to make a distribution directly from your retirement account to your qualified charity. And you can do up to $105,000 this year. Next year, it's going to be up to $108,000. But what that does is it skips your income statement completely. So by making that distribution directly to the qualified charity, you don't pay taxes on that $105,000, where you otherwise would recognize that as income and pay your marginal tax bracket on it. And in many cases, if you're over age 73, you're required to take a minimum distribution out of that account anyway. And a lot of people want to avoid taking those required minimum distributions, again, so they don't have to pay taxes on it. So this qualified charitable distribution qualifies and satisfies that RMD requirement. There was some legislation a couple of years ago called the Secure Act 2.0 that changed this strategy a little bit. It indexed it to inflation, so that number, that $105,000 limit, will keep going up every year, based on inflation. It used to be that it could only go to a qualified charity, but now there are some other options. You can do it to a charitable remainder trust, which we'll talk about in a moment. and some of the other areas. But for the most part, making that donation directly to that charity from your retirement account can be a very, very smart strategy. And by the way, if I might just plug Bill and his team and the value that they bring to the table, and your advisor, if Bill is not your advisor, you know, they can help you, create a strategy for this specifically, again, that is more specific to your financial plan, right? Understanding where you fall in your tax bracket, understand where the source of your funds are that can give you the maximum benefit. Deciding to either do this strategy or another strategy and prioritizing strategies, they just add a ton of value in trying to help determine the best way to give. So I'm giving you various options here, but it really only makes sense to make these decisions in full context of your financial plan. So give Bill and his team a lot of credit for helping, sort of create these strategies here. Now, I mentioned that, sometimes it really matters when you're giving and you're trying to strategize around your giving. It really matters where your tax bracket is. Now, here are your, 2024 federal tax brackets. This probably looks familiar to you. And especially when you're maybe on one of these thresholds where your income might put you into a higher tax bracket or might otherwise disqualify you from other deductions that you might be eligible to take. Some of these charitable distributions that are not taxable actually reduce your taxable income and bring you back down below these thresholds, again, saving taxes. So you should know where you fall or approximately where you're going to fall in your marginal tax bracket this year. And especially if you're close to one of these thresholds, it's worth a conversation to be had with your advisor and a CPA to see if we can using charitable contributions, bring yourself down below those. Another area that needs some attention is whether you claim a standard deduction or an itemized deduction on your tax return. Some of you may or may not know, about 10 years ago, they made a change in the tax code. It was the Tax Cuts and Jobs Act, the so-called Trump tax cuts, that raised the standard deduction for most Americans, therefore saving, a lot of taxes there. But they reduced your ability to do many of the itemized deductions. There are still some itemized deductions, and many of you still itemize, but most Americans now don't itemize their taxes. But one of the most common reasons why one would itemize their taxes is the charitable giving. You'll see on the right-hand side, these are the things that still remain that you can deduct in your itemized taxes: medical expenses, the famous SALT taxes, the state and local taxes, at least up to $10,000, mortgage interest, and charitable gifts. So we should know whether we are planning to take a standard deduction or an itemized deduction, and you can sometimes manage the timing of your charitable giving to help maximize whether you're going to do that. I'll get to that in a moment in terms of, I'll give you a good math problem on how to maximize between standard and itemized deductions. So when to consider giving is intentionally to maximize that deduction, right? Maybe there's been a spike. If you're self-employed, maybe you've got a big spike in income that might have reduced your ability to take a qualified business income deduction, a Section 199A deduction. If you're a business owner, you know what that is probably. And maybe you have a spike in that income that you need to sort of offset with some of this giving. Or maybe, it's prior to retirement, you're in your highest income earning years, you've deferred some of your salary till the end of your career. Maybe you're experiencing that now, and we need to bring that income down. Or maybe you realized capital gains in your portfolio. Maybe you sold some real estate, you sold a business, and again, you're looking to offset some of those gains with a charitable distribution. Maybe you did some Roth conversions in your retirement planning. Maybe you sold some stock or exercised some stock options, that sort of thing. So if you have kind of an unusually high income year or series of years, these charitable contributions can make a lot of sense to bring that stuff down. So let's talk about timing just a little bit. And I want to introduce you to the concept of bunching. Okay, you might have heard of this term before, but I'm going to kind of lay it out to you. Bunching, which is again choosing to be very intentional about the timing of your gift. Many of you actually give gifts, year over year, the same gift every year. That's actually very common. So if you go to a church and you pay a tithing every year, 10% of your income to the church every year, this might be a similar scenario to you. So on the top here is a very simple tax return concept here, where somebody's considering the deductions in their tax return. So on the top here in the blue, you've got 4 years, right, of continual tax sort of situation for this person. And every year they can deduct up to $10,000 of their state and local taxes. Okay, like clockwork, they do that. In this simple example, we're not going to look at any mortgage interest or anything like that. But then you'll notice that they have a $25,000 charitable donation, say to their church every single year. So every year with the STALT taxes and the charitable giving, they can deduct or at least itemize $35,000 in tax deductions. Okay. Now that exceeds the standard deduction. So your software or your CPA is going to say, yes, let's itemize your tax deductions. And over a 4-year period of time, you've now deducted $140,000 in tax deductions. That's just what it is. That's the math. Now consider an alternate scenario here, and it's down below in the green, where you decide to bunch all of your charitable donations all together. So instead of giving $100,000 over 4 years, you give $100,000 all in year one. Okay, and let's see what that does to the math. So in year one, you can still deduct $10,000 of state and local taxes. There's no mortgage interest in this example, but in year one, you've got this huge tax deduction, $100,000. And so your total itemized tax deduction is $110,000. That way exceeds the standard deduction. It totally makes sense. Everyone's happy. That's a great tax outcome for that year. Now, in years 2, 3, and 4, you've already front loaded your charitable contribution. You're not going to do that again. So when you go to itemize your taxes, you only have $10,000 of state and local taxes. There's no mortgage interest and there's no more mortgage charitable donation. So your standard deduction becomes more appealing at this point. So you're just going to take the standard deduction in years 2, 3, and 4. You're not itemizing anymore. And all of a sudden, when you do the math, if you just add up all the standard deductions plus the itemized deduction in year one, you've now deducted $197,600 from your taxes. If you do the math here, if you're sort of following along, you've basically manufactured out of thin air $57,600 in additional tax deductions, not by giving more, but by simply being more intentional about the timing of that gift, all in year one. So this makes a lot of sense to bunch those deductions for maximum benefit. And you've got to look at a longer period of time, over a 4-year period of time, to maximize your tax situation. I hope that makes sense. This is a great conversation to have with your advisor. And even better if you bring your advisor together with your CPA to produce some of these more financial planning benefits. So one of the questions people ask me is, okay, I get it. I'm charitably inclined. I think there's some great strategies that can help me save some taxes here. I want to go ahead and do that. I've got simple ideas. I've got more complex ideas. So how should I actually consider giving? Should I give to my church? Should I give elsewhere? So charitable structures range anywhere from very simple to very complex. Very simple, again, you're giving direct gifts to, your recipient. You give cash, you give personal property, the QCD strategy that we talked about before. If you want to take maybe one step higher, there are some philanthropic structures out there. One of my favorites is called a donor advised fund. Donor advised fund is basically like a fund, like a mutual fund, that you can donate. And, let's say you want to give that $100,000 to your church, but you don't want to give it directly to your church right away. Maybe you actually give it to this donor advised fund, where you can actually take credit for the charitable donation in the year that you fund this donor advised fund, but then you can space the distributions from that fund to your charity of choice over time. And a lot of times these funds have investment options that will allow those dollars to grow. So you can actually give more at the end to your charity than you did originally fund it with. So these are fantastic vehicles. You can ask your advisor about these donor advised funds. I'm certain that they have access to those for you. So you might take one extra step and go a little bit more complex and maybe get a little bit more different benefits that way. Other people might fund actual trusts, like split interest vehicles, actual like charitable trusts. And these are typically for larger dollar amounts. And typically, if you want to control how that charity receives those donations over time, you might consider those. I'll give you one example of that later on. And for very wealthy families, you might consider actually setting up your own private foundation. Again, if you want to have more control over who and how and when to grant these donations to the final recipients, these can be more expensive to administer, and there's a lot of tax rules around them. But for very wealthy families that are giving large dollar amounts, I mean, millions or tens of millions of dollars, this might be an appropriate road to go through. So let me give you an example. I'm going to give you a quick example of a charitable trust. Okay, this is called a charitable remainder trust. Okay, and basically what this is it's an irrevocable trust that provides an income stream back to yourself or to beneficiaries, like a spouse or a family member for a defined period of time, right? So you're funding this trust with usually appreciated assets, and then you're receiving distributions back. Those assets, they're invested and they grow, they spit off income and capital gains and other things like that. And you receive for a period of time income back from those dollars. And then at the end of the term, whatever remains in that trust that you haven't distributed back to you based on the formula that you use goes to your charity at the end of the term. It could be 10, 20 years from now or at the end of your life. Now, the benefit is that once you fund this charitable trust, you receive a charitable donation. It's an irrevocable trust. You can then claim that you have given these dollars to a charity. It's based on some formula. You then receive income back for a period of time. Some people say, well, I don't need that income. I'm going to use that income to buy a life insurance policy, and I'm going to fund that with another type of trust called an ILIT, a irrevocable life insurance trust, to replace the money that would have otherwise gone to your heirs, but you gave to charity instead. That's a common thing to do. It's optional. But then again, at the end of the term, the charity of your choice, whether it's your church or another 501(c)(3) organization, receives the remainder of that trust. These are pretty common, again, and there's a lot of variables and uh, um, procedures that you can, put into the trust agreement to make it exactly the way you want it to happen. And especially now when people are doing a lot of estate planning. Okay, and they're thinking about their overall estate, and especially if you have a large estate that might be subject to estate taxes, this is a great way to give assets out of your estate while you're living, so that you don't have to pay those estate taxes later on, and then your beneficiaries receive some form of income from that gift, for a period of time. So if you haven't done estate planning, this is a good opportunity to think about that. I won't go deep into this topic because it can get fairly complex. But as you approach retirement, or maybe you're already in retirement, that's a great opportunity to think about what your legacy is and whether some of this gifting strategy might be a part of that legacy. And by the way, one last sense of urgency here. Some of the estate tax provisions were part of that Tax Cuts and Jobs Act that I told you that was passed a few years ago. That's actually scheduled to sunset at the end of 2025. Those were the so-called Trump tax cuts. They raised the estate tax exemptions to the highest that they've ever been. So if if your situation and you're a wealthy family that has a lot of money that will be subject to estate tax, locking in those higher estate tax exemptions today, or at least between now and the end of 2025 when they're scheduled to sunset, can be a pretty urgent need. So it's just a reminder that you should be working with your financial advisor to bring estate planning into your financial planning conversations, and especially now that some of those favorable provisions are scheduled to go away. Now, the next question people ask me is, okay, well, what do you think? Are these things actually going to be allowed to expire and sunset, or are they going to extend them? Well, it's going to depend on who wins the election today, what the makeup of Congress is going to look like in both, the House and the Senate, and what the appetite is to extend those tax cuts, no matter, who wins and what the makeup of Congress looks like. So I can't really predict what's going to happen. My best guess is that they will be allowed to sunset. There has to be proactive legislation to actually extend them or make them permanent. And I don't know about you, but I don't have a lot of confidence in our political system at the moment, to be able to get that proactive legislation over the finish line. So I think it would be smart to maybe make some of these adjustments, kind of as a use it or lose it type scenario, because losing these more beneficial tax provisions is probably pretty likely. Okay, so just to kind of give you a little bit of more of a picture, I didn't talk about all of these different charitable structures for you today, but what I want to just demonstrate is that there are trade-offs of the type of gift that you give, and what your deduction might look like. Again, whether you give cash or appreciated security, or how expensive it is to actually set up the structure. Potentially, if you're going to go all the way into creating a charitable trust or some type of private foundation, whether you want to retain some level of control over the asset. Most cases, when you give an asset, you don't have any control over it, but that's actually not true. Depending on how complex it is, you could retain some level of control over the asset. The administrative expense is usually a factor. And because the administrative expense is a factor, it makes sense to consider kind of a minimum amount of funding the structure, to make it worth, paying some of the administrative effects on it. So whether you give a direct gift very simply, or go all the way into creating a private foundation, in a very complex way, there's usually something in between that you can think about. And again, to kind of shout out to Bill and his team and his firm in general, they're very good at helping you identify where on the spectrum you could or should be with your charitable intentions, and how complex or not it should be, and when to give when it is most favorable for you in terms of your tax situation. So you probably came into this thinking that this was all really simple, and it can be, and it should be. But for more complex situations, I think there's a lot of planning that can make this much better. A few final thoughts, and then we'll, kind of wrap it up and see if there are any kind of questions or concerns or any comments or anything like that. But, when you're talking about philanthropy, and especially with your family, right? Facilitating discussions around philanthropy is challenging, but also extremely rewarding. Because remember, as I mentioned before, the motivations that people have to give to charity are usually pretty complex. And they usually have to do with things like values and principles and intentions, and identifying a need in the community, and some of the issues that really impact that family specifically. And so having those conversations can be highly rewarding, because it's one of the few opportunities we have to talk to our family about those values and principles that we have. I have this opinion, and you might agree or disagree, but I have this opinion. We used to talk about these values and principles more often. We used to rely on a lot of institutions in the past to help facilitate these conversations. So, like churches and community groups and fraternities and membership associations and things like that. But we're not really a part of those as much as we used to be. Just in general, you may still be personally, but just in general, Americans are not part of those institutions as much anymore. So the opportunities to have those conversations around values and principles don't really happen as much anymore. So this is a great opportunity to intentionally talk about it. So maybe some questions that you might ask yourself, or even better, that you raise with your family proactively is, how do you decide how much to give every year? Right? Whether you tithe to your church, or again, any other sort of organization that you care deeply about, how do you decide? How should you decide? Is there a principle there that you should talk to? What do you currently donate? Is it cash? Is it property? Is there maybe a better way to do this? Do you typically itemize your tax deductions, or do you typically claim a standard deduction, or does it depend on the tax year? How important is a charitable legacy to your family? How much do you want to take credit for the charitable giving that you give? Are there any social causes that are particularly important to you or your family? What inspires you to give? Again, those are very rewarding conversations to have, even with your kids and your grandkids. Like, what inspires you to give? How did you decide that this charity was the one that you were going to support compared to this one? How involved do you want to be in actually charitably giving? This is a great opportunity to get kids and grandkids involved in the charitable giving efforts. I was working with a family, a very wealthy family recently. Their kids were still pretty young, and they included their kids in the conversation about which charities to donate. And they ended up with a list of charities, but many of the charities on that list, they never they didn't imagine making donations to those specific charities when they began the process. It was because their kids were involved in the process that they landed on choosing the charities that they wouldn't have otherwise considered, which again was very surprising, but very interesting conversation. Think about and try to actually spend quite a bit of time thinking about, how are you going to feel after you make these donations, right? Try to consider in advance how much this is going to move the needle for you in terms of your own personal happiness and motivations. Do you feel satisfied on making some of these charitable donations? So these are the type of questions you should ask. Some of them are related to taxes, which we've covered a little bit, but most of them are like, how? How do you want to do this? How do you want to make the biggest impact? How much control would you like to have over some of those charitable donations? And in which way can we best align our personal needs and tax benefits and other things like that with the needs of the organization that you're thinking about? So let me pause there. Bill, let me see if there are any kind of questions or comments or anything like that that came through.
Yeah,
And I'd love to
Devin,
hear some of your experiences as well.
yeah, Devin, first of all, that was fantastic. That was exactly what we were hoping for by having you on today. So you checked the box. You did a great job there. So we appreciate it. I do have a couple of questions that have already come in. For those of you, if you do have questions, remember it is an email. Send that email to Cornerstone WM. Again, no dots, no spaces. Cornerstone WM at LPL.com. Those will come to me, and then I'll ask Devin. Before I get to the question, though, Devin, we asked you obviously to speak about charitable giving today. I guess I can officially say that we're getting into the holiday season since we're past Halloween. So let's just say giving in general. So let's say someone decides that they want to gift some amount of money to their loved ones, and the way that they've maybe always done that is to sell some stock that's done very well, turn that into cash, and then give their loved one, family member, grandkid, whatever it may be, just give them cash. Is there maybe a better way to do that?
I think so, yes. And you already mentioned it is, suppose they have appreciated stock that they're considering to be the source of the gift, right? They just take the extra step of selling the stock and then giving cash. But consider, like, some of your kids might be, say, they might be in their working years, or maybe they're college students. They don't have a lot of income, for instance. You may decide to just give them that stock directly. Now, what'll happen is they'll take that stock and they'll sell it, right? They'll recognize income for themselves. But if they don't really have a lot of other sources of income, or maybe they're new in their career and their income is relatively low, they're in the lower marginal tax brackets, it's going to be better for them to sell the stock and recognize the income under their lower marginal tax brackets than maybe you doing that under the same with your higher marginal tax brackets. So if you're gonna buy a car for your kids as a gift, give them the appreciated stock, avoid the tax liability yourself, let them sell it, let them use the proceeds to buy that stock. Now, the next question people ask is, well, what about gift limits, like annual gift limits? And that is a thing. So in 2024, this year, you're allowed to give $18,000 per person per year per recipient. Any gift that you want, whether it's cash or appreciated securities. If you're a married couple, you can double that up, basically. $36,000 per year tax-free. If you exceed that, you could either pay a gift tax or you could file it as a part of your unified gift tax credit. I won't go into that, but you're allowed to give a lifetime exemption of gifts. It's like $13.61 million per lifetime. You can just kind of deduct a little bit from that in terms of a gift tax. But if you're under $36,000, you don't even have to report it as a gift. But give them appreciated stock, let them sell it, let them pay a small capital gains or zero capital gains if they're in that category, and then relieve your own self of that tax liability. Did that answer your question, Bill, or did you want me to go deeper in there?
No, that's great. That's exactly what I was looking for, and that might even be a strategy for folks who have a maybe over concentration in one stock, yeah, that they've held for a long time, and maybe it's a sentimental holding. This might be a way where they could gradually reduce some of that risk of just that one position. I do have a question. I think this is a really good one. And Devin, on your last slide, you were talking about having that conversation with families and maybe getting kids involved or grandkids involved in the philanthropic endeavors of the family, or maybe share values that you have. And this question actually is kind of the reverse of that. And it's, do you have any tips for adult children to broach the conversation of estate planning or family philanthropy with their parents? The parents aren't getting any younger, and the kids are maybe starting to worry about what this could bring if they don't have that conversation.
Yes, that's such a common thing. I hear it all the time. In fact, my wife is in a similar situation where this is my background. This is what we do. This is what I'm good at, and her parents know that. But they still have this hesitancy to talk about it because maybe it's a generational thing. Maybe there are other reasons why some people are somewhat protected to have those conversations. So what we're doing is over time normalizing these conversations. It might take some time, but normalizing them and being completely transparent, which is sometimes hard to do, by the way. But what I mean by being completely transparent is talking about specifically the reasons why you might be bringing it up. So for example, if I want to go to my wife's parents and say, look, I think estate planning, might make a big difference here because, and I'll tell this a personal true story. I just recently lost my parents within the last 2 years. And some of the estate planning that my parents did before they passed actually created some huge benefits for me and my siblings in terms of administering their estate, passing through probate or not having to go through probate. There were some rules around the disposition of assets and other things like that that were very clearly put out in their estate plan. That was a huge relief that allowed my siblings and I to focus on grieving the loss of my parents as opposed to trying to scramble to settle their estate in the end. And so sharing those stories, personal stories with me, about me with my wife's parents, have allowed them to better open up because they understand what objectives we have. We said, look, we don't want this to happen on my wife's side of the parents. If there's a problem, we had such a great experience on my side of the family that we'd like to extend this to this side of the family. That's a pure, genuine, sincere objective. And so being transparent about that sometimes helps. If you don't have a situation like mine, bring in other issues. Say, look, my financial advisor, Bill, was talking about this, and he told horror stories of other clients that he had in this situation. We want to try to resolve this earlier. I read an article, about this. This is important. Or the Trump tax cuts and these higher provisions are going to expire at the end of 2025. We should talk about this as a family. But be intentional about the values and principles as opposed to the money and the financial assets. Let that be a conversation later on. Let's focus on the values and principles first, and then the financial stuff later. I don't know. But I will say, some of the surveys that we've seen, most people want to have this conversation and they want their financial advisors to be part of this conversation. About 80% of them say it's important for their financial advisor to have conversations with their kids and grandkids about these types of issues. And, Bill and his team, they spend a lot of time educating themselves on how, the mechanics of all this work, but also how to facilitate good conversations between families so that we can avoid some of those landmines that sometimes crop up and prevent us from talking transparently.
Devin, I'll just give one quick plug there for PIMCO. And I know you all do some great work on conducting family meetings. So for those of you listening, if that is a topic that you would like to address, certainly a topic for a different discussion today, but reach out to your financial advisor and say, hey, I heard that guy from PIMCO and he said you could help me with a family meeting. And I'm sure you all have great materials to
Look,
make that happen.
and the best reminder is that every family is dysfunctional. Yours is not uniquely dysfunctional. Everyone's is dysfunctional. And we were just working with a very wealthy family. They just sold their business, $500 million. They were talking with their kids and grandkids about what they wanted to do with this money. And they were very dysfunctional, right? These are kids that were suing each other over business interests. And we were able to, again, focus back on the values and principles. Let the disagreements, if there's going to be disagreements, let it be on how the assets are managed, not why they're managed. And so we were able to align them on the why this family's purpose existed. And then the disagreements on the how actually became much, much easier to solve from the financial aspect. So it's doable.
That's great. Well, Devin, I can't thank you enough. Also want to say thank you to everybody who joined us today on a very busy day. I will try to plan better next time to where we don't do this on a major national occurrence. But that being said, thank everyone and really appreciate your time today. Bye-bye.
Thanks, Bill.